3 years ago, I decided to stop investing like my grandmother and start moving in a more aggressive direction. One of the first indicators I learned was EMAs, or the boring version, exponential moving averages. These allowed me to get a better idea of where stock prices were headed as a beginner trader. Typically, people use 3 different time frames on their EMAs. That consists of the 200, the 20, and the 50, but everyone's trade style is different, so you may see different days with different traders. Not to get all Investopedia on you, but the best way to explain EMAs is by first talking about SMAs, or simple moving averages. To explain SMAs as simply as possible, it is basically the average price at any given point throughout the day based on that time in the past trading days. If you're using the 5 SMA for example, it would be based on the last 5 days at that exact time. For example, say we have Apple stock and we're calculating the SMA for market close. I know we don't like math, stick with me here, it's almost over. Apple closes at $10, $14, $11, $11, and $12. We want to calculate the 5-day SMA, so we would add all of these prices and divide by 5. This leaves us with around $11.60 as our 5-day SMA at market close. Now let's take a little pause and just look at yourself. You're 2 minutes into this video and you not only know what an SMA is, but how it's calculated. Now what good is this info if we don't understand what it's used for though? Now I'm assuming you're an investment baby, but in technical analysis we have these super simple concepts called supports and resistances. Now you need to understand how the market moves based on supply and demand. Every stock has a set supply and the stock price will move based on the amount of demand. So these support and resistance levels are basically levels where traders believe that there will be a pause in price action or a reversal due to buying or selling pressure. The SMA being an average of the last 5 days closing prices, we can assume that buyers or sellers will act at around that price because that has been an attractive level for them over the last 5 days. Now do we remember EMAs from about 5 minutes ago? Jesus fuck, I hope you remember this, or else this whole learning to trade thing might just be a pipe dream for you. Anyways, we use the EMAs the same way, as a support or resistance. Basically, if we approach our EMAs, we can expect a reversal in price action or an aggressive break through it. The most popular use for the EMAs is to spot trend reversals. A reversal is a trend change from an uptrend to a downtrend or vice versa. To find these reversals, you can look for 2 things, a golden cross or a death cross. A death cross happens when the 50-day EMA crosses over the 200-day EMA from above the 200 to below it. A golden cross is when the 50-day EMA crosses the 200 EMA from below to above. Using the chart we have here, you can see that once both the 20 and 50 EMA, the red and the yellow, cross the 200 EMA, the green, we can produce a massive move to the downside. This move, shown on the screen, totals 20%. You can also use the EMA in trend following. The first step is to find a chart that is trending. The second step is to find which EMA makes the most sense for your chart. Most people will use the 100 or 200 EMA for this. We look on a 1-day or 1-week candlestick chart. A bullish continuation would be if price is trending above 200 EMA and continues to trend above. A bearish would be the opposite. The chart shown is a perfect example of this. We see trading within a downtrend and price has an aggressive push up towards the 200 EMA and even breaks above it. Being an EMA trader though, we do not feel bullish until we see our golden cross, but the EMAs reject a breakout above the 200 and make a lower low. This results in a 16% move to the downside. Finally, why am I using EMAs every day in my trading? We covered how the market moves based on supply and demand, so using indicators that are basic and simple means that there are a lot of eyes on said indicator, or that it's popular, which may cause price to be reactive when the indicator sets up. Another reason is the EMA's accuracy on finding reversals when crosses are present. The EMA crosses are pretty accurate but should also be paired with other indicators in order to have more conviction. We will cover other indicators on this channel and how to pair said indicators in other videos, so please subscribe and like this video for more.